In Chapter 15, we will study asymmetric information. In some market transactions, some information may not be available to all the parties involved. Some parties may not know some important attributes to a person or a product in the transaction, so there are hidden characteristics. In some situations, one party to a transaction cannot observe important actions taken by another party. This kind of information asymmetry is called hidden action. Hidden characteristics can cause a problem called adverse selection, and this adverse selection problem can result in market failures. The classical example for adverse selection is the used car market, and we will look at this example first. We start by assuming that there are 2,000 used cars per year available to be bought in the used car market. 1,000 of them are lemons. Lemons are bad quality used cars. They have various problems and often need many repairs, which give the owners headaches. But there are also good used cars. They have been maintained very well and they don't need a lot of repairs. We assume there are 1,000 used cars that are lemons and the other 1,000 are good used cars. We also assume that the sellers of these cars cannot alter the quality of these used cars. To start our discussion, we assume first, both sides, both the buyers and the sellers, know the quality of the used cars. That means the information available to the buyers and sellers is complete and symmetric. On the demand side, the buyers would like to pay $4,000 for a lemon, a bad quality used car, and $8,000 for a good used car. Notice that these demand curves, doesn't matter whether it's for lemon or good used cars, these demand curves are horizontal, meaning that at this $4,000 for lemon or $8,000 for good used cars, the quantity demanded is infinite. As long as there's somebody is willing to sell at $4,000 for a lemon, there will be a buyer. Or as long as there's a good used car available to be sold at $8,000, there will be a buyer. The owners of the lemons have a reservation price of $3,000 per lemon. The owners of good used cars either have a reservation price of $7,000 per car or $5,000 per car. These two alternative assumptions will become very useful later on. Because the available used cars in each category is just 1,000, so once the quantity demanded goes beyond 1,000, the supply curve becomes vertical. There's no more cars above 1,000 to be sold in each category. So in the market for lemons, these 1,000 lemons will be sold at $4,000 since at $4,000 the quantity demanded is unlimited and there is only 1,000 bad quality used cars available for sale. In the good used car markets, these 1,000 used cars are also completely sold out at $8,000 per car. Again, because at $8,000 price, the quantity demanded is unlimited. In the lemons market, the total surplus is 1,000, the difference between 4,000 and 3,000, times 1,000 lemons, that is $1 million. This 1 million total surplus goes completely to the sellers because of this horizontal demand curve. In the good used car market, let's assume the reservation price for the owners of the good used cars is $7,000. So the total surplus is at least 1,000, the difference between 8,000 and 7,000, times the 1,000 used cars sold, that is another $1 million, and that total surplus also goes to the sellers because of the horizontal demand curve. So if we have complete and symmetric information in the used car market, at least we can have $2 million of total surplus realized. We can also quickly consider a different situation where the information is not complete, but it is symmetric, meaning that neither party, neither the buyers nor the sellers, know the quality of the used cars. Both sides are ignorant to the quality. Because nobody knows the quality of the used cars, the information is incomplete. Because neither side knows, this incomplete information is also symmetric. Because there are totally 2,000 used cars and half of them are lemons, there's 50% of chance for a buyer to buy a lemon, and there's 50% of chance for a seller to sell a lemon. We can assume that both sides are risk neutral, and each side is willing to pay or accept the expected value of the used cars. So on the demand side, the buyers would like to pay the expected willingness to pay, that is 50% times 8,000 for good cars, plus 50% times 4,000 for lemons. This expected willingness to pay is 6,000. On the supply side, we can assume the reservation price for good cars is at the higher value, $7,000. So 50% times $3,000 for lemons plus 50% times $7,000 for good used cars, we have an expected reservation price by the sellers of $5,000, which is less than the expected willingness to pay of $6,000. The market demand curve for the used car market in this situation is a price at $6,000 per car and horizontal. That still means that at $6,000 per used car, the quantity demanded is unlimited. However, there's only 2,000 used cars available for sale. The result is that all the used cars are sold at $6,000. The realized total surplus is $1,000, the $6,000 price minus the expected reservation price of $5,000 times 2,000 used cars sold. We have $2 million in total surplus. That realized total surplus goes to the sellers again because of this horizontal demand curve. So based on what we have seen, as long as the information in this market is symmetric, either both sides know the quality of the used cars or they don't, then there can be at least $2 million of producer surplus realized in this used car market. Next, let's think about asymmetric information. That means the sellers know whether their used car is a lemon or a good used car, but the buyers no longer know that information. This is quite realistic because the sellers know how well they maintain the car and their own driving habits, whether that will damage the longevity of the car or not. But because the buyers do not know these sellers, they do not know what kind of quality for the used car they are selling. Because the buyers no longer know the quality of the used cars, they still have an expected willingness to pay for $6,000. Obviously, for the lemon owners, they are very happy to see this situation because then they can sell something only worth $3,000 to them at $6,000. They can make $3,000 of producer surplus. If the reservation price for the good used car owners is at $5,000, they are also very happy to sell because that reservation price, $5,000, is still below the $6,000. Remember that the buyers have a willingness to pay of $8,000 for the good used cars. Because there is this 50% chance for buying a lemon, they reduce their willingness to pay to $6,000. So the sellers of good used cars suffer from this information asymmetry. However, because for a buyer there's another 50% of chance to buy a good used car, they are willing to pay more than the $4,000 willingness to pay on the lemon. So that actually increased the price received by the lemon sellers. In essence, the lemon sellers benefited from this situation, and the good used car owners actually subsidize the price that the lemon sellers can receive with their good used cars. Remember in this example that we assume the reservation price for good used cars is the lower value, $5,000. That's why in this market, there's no adverse selection yet. But if the reservation price for the good used car owners is $7,000, that is above this $6,000, the good used car owners will realize they can never sell their good used car at a price that they are willing to accept. So they actually withdraw from this market. Then eventually the buyers will realize there's no good used car in the market. Every used car you are going to buy is a lemon. So they will only pay $4,000 per used car because all of them are lemons. And there are only 1,000 lemons to be sold every year in this used car market. So in this situation, the asymmetric information, the fact that the buyers cannot tell the difference between a lemon and a good used car, resulting in that the lemons drive good cars out of the market. And that's what we call adverse selection, because the market transactions drive out the high quality products and only the low quality products left. So the market selects quality in an adverse direction. In this market, there's only $1 million of total surplus left because the lemons are selling at $4,000 per car and the reservation price of the lemon owners is $3,000. So there is $1,000 total surplus per car, and there is 1,000 lemons sold per year, and the product is $1 million. That means we cannot realize another $1 million in total surplus for the good used car owners and buyers, because the owners of good used cars have a reservation price only at $7,000, but the buyers would like to pay $8,000 per good used car. And these transactions do not happen because of the asymmetric information. And the high-quality cars remain in the hands of people who value them less than potential buyers do. In this situation, asymmetric information causes an otherwise perfectly competitive market to lose its desirable efficiency properties.